Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for April 16th of 2023. Here's our disclaimer for important information. Hello, everybody. Hope everyone's doing well. This being tax week, so hopefully that's going well for you. You've got your taxes done and ready to go. Start the chart pack this week with a couple of things on China. Then we'll move into some economic observations. We had PPI, CPI readings to kind of talk about. And then we've got some market-related observations as spoken to us through the charts, as this is Charts and Chat. So we'll get started here with China. Something I've shown in a different version to you in the past, but this is a chart on trade and direct investment. And in the blue line is very representative of what you'd expect given the climate between the two countries, that foreign direct investment has clearly tailed off over the last couple of years. However, despite tariffs, that we've actually seen kind of this fishtail uptick in the kind of this orange line here in net trade. So as much has been made about the animosity between the two countries, and as much was made about the decline in overall bilateral trade during the Trump era implementation of the Trump era tariffs, we do see that trade has definitely picked up over the last several years. A quick chart on Chinese consumer sentiment. You can see that after the cessation of the COVID restrictions, that sentiment is clearly picked up. It's probably what you certainly would expect to see, both on a 5-day and a 30-day moving average. This is actually very important to the emerging markets, and it's almost kind of humorous to think of an economy as large as China still being labeled in and kind of basketed within the emerging market community, but it is. But clearly you see here China sentiment, which is not quite as important to the Chinese as consumer sentiment is to the US, but still very important nonetheless. Quick look here as we get into some banking issues, overall economic issues. This is from FS Investment. You got in the orange line, net percentage of tightening standards. So this is kind of flipped on its lid here. So what this, meaning that it's inverted. And so what you see here is that clearly this downtick represents an increase in tightening standards. And you look at the 1990 back in 2000 to 2002, 2008 global financial crisis, we had these downticks in this number. And so what this represents is that credit has become a lot tighter, as typically would be the case during a recession. Banks are trying to protect their own financial interests, et cetera. And so we're heading in that direction again. You see the overlay here on real GDP. And so the implication on this number is that GDP is set to, at best, remain sluggish, if not continue to slide. And so, as we have seen this resilience in the economy, we'll talk about this throughout the chart pack. If we in this conversation that we were having in this very forum, 6 months ago, I thought that we'd see more rapid deceleration, and that by the time we got to the midsummer, we would already be looking ahead to that next cycle. And the resilience of the labor market, as well as here, at least until a few months ago, the resiliency in credit being extended by banks and national income, that we've kind of pushed this this continued decline out a little bit. And so, black line here probably continues to at best trend lower than what we see the long-term trend line is, real GDP on a year-over-year basis. So we'll continue to monitor this. A quick look at some of the lending programs on the Fed. And again, Silicon Valley Bank, we're kind of like putting that in the rear view mirror now. And you can see here in all of these Fed programs, and the bank term funding program on the bottom is the one that was actually just implemented for this particular crisis. You can see borrowing still relatively high, but then they're trailing off their peak. This is a weekly number, and so you see kind of overall Fed discount window usage. And I talked about this last week, where you might see this term funding programs still remain high, but it's being more than offset by the decline in usage of the Fed discount window. And you can see from a net standpoint combined, which is at the very top of this, that overall demand for cash from the Fed is down for the fourth straight week. So again, we're putting this crisis in the rear view mirror here for the time being. Here's commercial bank deposits rolling over a little bit, not to be concerned necessarily. You see that they're still above that long-term trend line established in the last decade up until the pandemic, but they have clearly gone down. Some of this is a disintermediation, is the term for it, into money market mutual funds, people taking cash that's not generating a lot of interest necessarily and moving it into higher performing vehicles. Cash as a percent of total bank assets can still moving in that same direction. Again, this represents disintermediation. You can see the acceleration in cash reduction much more pronounced on the small banks. Again, that's a direct function of what we're seeing overall in this disintermediation. Rates are higher. People can get better performance, better yields elsewhere. And in very liquid instruments. So cash balances as a percent of total bank assets are clearly pretty sluggish right now. Here's a quick look at monetary policy within the purple here. You can see the overlay of the Fed's balance sheet. And this is not a linear representation. If you look at the left-hand scale, you can see that it's really almost kind of logarithmic in nature, and you can see that obviously 1942 is when you really begin to see this data populate. Balance sheet expanded during World War II, and what's really interesting here is you get into the hyperinflation period of 1980 to 82. You see even though this is not quite on a equal scale, but you can see a fairly methodical and very mundane rate of increase in the balance sheet. And it wasn't really until we got to the global financial crisis that this concept of quantitative easing and an accelerated balance sheet expansion to try to help stabilize financial institutions and the broader economy really came into play here. And you can see that it's been used quite a few times. We know we went through several rounds of QE, and then we were at a point before the pandemic where, the Fed was reducing its balance sheet and then having increased it again in the wake of the pandemic. And you can see in a relative sense that we're pretty high right now, even though that number is trailing down just a little bit. And you can see the overlay here with the 10-year Treasury yield and that solid black line that during this kind of methodical expansion of the Fed's balance sheet that we've seen the secular decline in rates until we got to the inflationary period last year and rates went back up. And then you see the policy rate overlaid in that kind of that gray line. And so you can see how the relationships work there, but obviously we're still at a very low point. And I kind of show this for perspective's sake that, as high as we feel rates are, that if we look back over decades, that they're actually still fairly low, relatively speaking. We'll look at our 3-month Treasury bill rate, and the expectation now is fairly strong that at the Fed's next meeting they're going to raise rates another 25 basis points. Well, the sea change of opinion was pretty dramatic after Silicon Valley. People said, hey, we need to stop, we need to pause, we need to kind of assess and do damage control, et cetera, et cetera. And again, like I said, a lot of that hysteria is kind of in the rear view mirror right now. And the fact is that we still have pretty high inflation, even though it is coming down. So here we have the 3-month T-bill rate at about 5.1%, and as Charlie Bolello points out here, it's the highest point that we've seen since 2007. So short-term instruments are yielding fairly well right now. And again, this is helping to contribute to this disintermediation that I've been talking about out of bank cash deposits and into alternative short-term investments. Quick look at some job and labor market related data. Here we've got jobless claims still pretty low. Layoff announcements have come up a little bit, but the labor market remains fairly strong overall. Here's continuing claims, and I think this is from a kind of a trend line basis, a little bit more meaningful perhaps than the initial jobless numbers that we get week over week that are pretty stubbornly low. But here we see continuing claims perk up a little bit, and as this chart from Macrobon shows us that when you do have these extended spikes in continuing claims, this is kind of like what they call the U6 number for the Labor Department. And when you have these extended rises, it typically overlays with recession. And so this would tend to corroborate the theory that there is a recession kind of in the future, looking out that front dash of the car that's moving forward. Although still the speculation is that it's going to be fairly mild, but it is probably still one of the most anticipated recessions that we have had in modern history here. Consumer confidence is, I'd say at best, tenuous. It's not optimistic. It's not pessimistic. Michigan consumer sentiment is in that orange is a number that's much more influenced. The level of this index is much more influenced by people's perception of inflation. And so as inflation picked up, certainly in 2021 and accelerated into last year, that you can see how that has caused that University of Michigan number to be influenced. Now, the Conference Board consumer confidence number does have some inflation influence, but not nearly as much as the Michigan number. And you can see that it's just kind of like holding its own right here as we tread through the current environment and try to assess, where we're going to wind up next year. Here's consumer debt as a percent of disposable income. If you look at this number, the takeaway here is that relative to, as you can see here, like 2003 to 2006, when it was rising and we were getting ourselves into kind of a pickle, although we thought we had credit default swaps and all these other financial engineering tools to kind of mitigate that risk. But you see overall debt levels have picked up, but they're still pretty low overall. And you see the components of this. Student loans have become a much bigger part of the equation here. Car loans have always been, but really the big change here is student loans are a big part of this. But you can see all flavors of debt are moving higher off of this low. But as we said, 6, 9, 12 months ago, that heading into an economic downturn, the consumer is in much better shape than they were heading into the global financial crisis. And then on the right-hand side here, we have delinquency rates. You can see that delinquencies for all credit types have gone up. Mortgages still pretty low, which is good. We definitely want to see that. That is meaningful to kind of the health and integrity of the mortgage-backed security market, at least for residential mortgages. And I am under the impression here, this being from Equifax here, that this is talking just about consumer mortgages. But you see credit card, auto loan delinquencies perking back up. Here's some data from Bank of America and some of the recent research. You got credit card spending per household. On the left-hand side is kind of the aggregate number, and it's barely above zero. Something that you probably would expect as we kind of witness some slowing in the economy. Even though labor market's pretty strong, there are people that have, once they spent their stimulus money, the lower income cohorts, they were starting to dig into their credit cards. and we could see that spending, and then that's trailing off. And so I think this is a foreshadowing. As we look on the right-hand side too, we've got retail spending, which is down, meaning that people are not using we're seeing an outright decline in the use of credit and debit card spending at the retail level, although services is still above its pre-pandemic level. But the implication here is that consumer spending will slow and is slowing, at least from the perspective of the use of debt. Quits rate, more job-related data here. We've got the quits rate is normalizing. This is a sign that, where I'd say the best way to describe this is, previously, the employees really had the upper hand, that they were quitting jobs because their jobs were aplenty. There was multiple available jobs for every unemployed worker, and anybody that wanted to quit to aspire to a different, even a different profession, let alone different job. But you see that that's reversing now. Again, sign of a slowing economy to some degree, although the labor market's pretty strong, as I've mentioned, and the quits rate is still at a pretty relatively high level. If you go back on this time series and see that, I mean, we're still above any other level except for the trailing 1 year period. On the right-hand side, we've got layoff announcements moving higher. Clearly, a lot of this has to do with larger companies, and these are kind of like announced layoffs, a la Facebook and some of these other large companies that issue press releases to these to this end. And then you see initial claims, again, pretty low, but perking back up a little bit. Wage growth tracker. This is something that is monitored pretty heavily on the part of the Fed and other Fed watchers. Wages are fairly sticky. So as we say, what are the sticky components of inflation? Well, wages are certainly one of them. Rents are another, although we can see, the prospect of some relief on the rent side in the front mirror. We were seeing a little bit of progress on wages moving lower. The latest uptick here is something that we want to certainly take note of, because the aggregate level of wages is still pretty high. So, I mean, this is something that if you don't get wages down, wages remain sticky until such time that the labor market does slow down, and then you get these wages rolling over. And this type of environment, if you're not controlling inflation in the market, again, we had a problem of negative real wages after subtracting inflation. Now that's beginning to kind of work itself out. But when that's generally not a sustainable situation. But we do have inflation coming down, but wages still relatively sticky here. Here is the University of Michigan. Again, we talked about that survey earlier, but this is the Michigan expected change in prices during the next year. And so we've seen a relatively pronounced change here over the last in the last reading, even though the reading has come down since about the middle of last year. And as we saw, some of these rate increases, the expectation for inflation was moving lower, because the feeling was that we were going to choke off inflation because of the rapid rise in short-term interest rates. And that was working for a while, but the last reading here at 4.6 is notably above about the 3.6% level that we saw in the prior reading. So inflation expectations still relatively high. Again, looking at this time series, it goes all the way back to the beginning of this century. Chart from Redfin on the mortgage rate locks for both primary and secondary homes. You can see the primary home number in the blue and then the secondary home in the red. And what's really notable about this is these rate locks have really dropped like a rock from pre-pandemic levels. In fact, you can see here, March reading is down 52% from pre-pandemic levels, and much more so than primary homes. So the read through on this is that the demand for secondary houses has dropped off. And, when you're in an upwardly sloping economy and you have a lot of liquidity and you have a lot of desire for mobility and remote working and things like that, like we had in the post-pandemic era there, that you have a lot of interest in these second homes, and that's really dropped off, and it's dropped off pretty precipitously. As a matter of fact, dating back to about this time last year, and I think this is just yet another indicator of the manifestation of a slowing economy. As we look at 30-year fixed mortgage rates here and this meteoric rise dating back to the beginning of last year, and then we got to the fourth quarter of this year and they reached their peak over 7%. They then came off their peak. We've been talking about this in terms of housing affordability and the health of the housing market and kind of the expectations therein. As some of the inflation factors look to be trending in the right direction, we saw that this, and certainly and more so, the 10-year Treasury yield came off its peak. And so we saw these mortgage rates drop a little bit. Now they have picked up a bit lately, and but they're still kind of in that kind of like 6 to 6.5% channel right now. We have some more interesting data. In the orange line of these bars here, you've got the Zillow rent index, and this is what we're looking at here is essentially a 1-year lag. And so even though it looks like this data is trying to populate for January of 2024, February, March, I mean, I think we've got the February 23 data, but it's being pushed forward a little bit because these things do work at a lag. And so, the implication here is you look at the black line being CPI rent of primary residence, and that is a real-time data. So the idea here is that you overlay the 1-year forward rent index with the current CPI data pertaining to rents. And we do know that, rent is very important, and owner's equivalent rent is very important to the CPI and even more so to the core CPI. And so, as we see this rent index begin to soften up here, again, it is, on this left-hand index, the rent index is actually down, but rents are still pretty high in the aggregate, that it should translate into some of the stickiness that's tied to rents of abating here over the next 6 to 8 months. Household formations and housing starts, saw this in the journal last week, data from realtor.com. Pretty interesting stuff here because, we've talked a little bit at times about household formation and people, working a little bit longer, enjoying life before they get married, having kids. So household formation had been, somewhat sluggish for a few years, and then we had the pandemic. And that number has apparently moved a little bit higher at the same time that housing starts have actually decelerated a little bit. So the interesting dynamic here is that you've got, a housing market that is very difficult for newly formed households to buy into, but you're also at a point here where we are essentially contributing to the supply-demand imbalance, meaning that there's not going to be enough homes for the increase in households. We'll talk about the office market for a second. Office vacancy rates pretty high. This is a Axios number, data from CoStar, and pretty telling here. This is a national number. Obviously, different geographies, different regions have variations of this data, but directionally, it's still pretty much the same. The future of office, obviously, still being defined here, but office vacancy rates are certainly picking up. We're above global financial crisis levels. And you can see here for office space available for lease, the sublet market is very robust right now. And so you look at commercial development, and this will tell you basically what you need to know. Lenders are a little bit hesitant to lend on office projects for these reasons right here that you're looking at. And developers are less interested in wanting to develop this type of product because of the uncertainty that's born out of this, rather dramatic rise in vacancies. We'll talk about import prices. We got some more economic data for you. We see import prices year over year down. We've got a weak dollar. We see that as kind of an interesting dynamic of a weak dollar. But I think this is more symptomatic of a slowing global backdrop than really anything else. Obviously, import prices are influenced by energy. We know energy's been a little sluggish, so that has contributed to it. But there's several different read-throughs here, and I think one of them is, again, this negative 4.6 number speaks to kind of the softness in the global economic backdrop. Here's the CPI number. Latest reading we got, core was up 5.6%. It actually ticked up a little bit, even though the overall number was down. And we have seen some relief in the food basket. Energy prices moving back higher. We'll see that in a chart coming up. And so distillate prices, gasoline, things like that are moving a little bit higher. So again, the story here is inflation is still higher than it needs to be. Might be coming down, but it's sluggish. But when you think about, going away on vacation, I've used this metaphor a lot, the temperature doesn't fall when you get back and you turn on your air conditioning, and it doesn't fall to the level that you want it, like in the snap of a finger. It takes a while. It's the same thing here. And we're looking at producer prices, PPI month over month. This was actually a big surprise. And again, speaking to maybe the health of the economy, maybe not the right term for it, but maybe a deceleration of sorts. So survey was looking for kind of a flat PPI number, and we actually got a decline of 0.5%. And if you look at the internal side of it, which is what I have on the right-hand side here, you've got core. Core was also down, and it was expected to be up a little bit. And you can see this kind of rate of deceleration here in overall core PPI. In that number, you see it was in line with the survey on the year-over-year number, even though month over month was below expectations. But you've got PPI moving lower. Here's continuing to drill down on PPI. We've got the services number, and this is what really drove the overall PPI number. We know consumer prices are still pretty sticky. Producer prices are coming down, and we can see that very clearly here, and especially on the service side. And I think what I take away from this is that we should be able to look forward to the dovetailing effect of CPI, because typically, producer prices, if they come down, eventually get passed on into the consumer price basket. And so, that probably works at a bit of a lag, but this is, in one respect, good data to see the deceleration in producer prices, but also it's a foreshadowing that we should see lower consumer prices in the months ahead. Here we have a chart that overlays the Fed regional surveys in this aqua line here, combining the various Fed districts in this data. And it's advanced by about 8 months here. And so the idea is here to show, these surveys. And this is feedback from business operators, business owners in these various districts on what they're feeling, what they're anticipating, what they're seeing. And so the idea is you advance that forward 8 months, because it is kind of a leading indicator of where your PPI trade services number is going to wind up. And we just looked at that, and we know that number is down, and it was a huge contributor to the shortfall in PPI estimates versus expectations. So we know producer prices are coming down, and what this chart tells us is that when you advance that leading indicator by 8 months and you overlay it with what's going on in the PPI trade services number, which we see right here in the black line, that trade services number has farther to fall. And so again, the read through, as I mentioned on that last chart, is that this will ultimately pass through into consumer prices. so happens that I found this chart from Ian Shepardson, which talks about the very issue that I've mentioned over the last couple of slides, is that this is what's going on with producer prices. Again, in this aqua line here is going to translate into CPI. And so this is the forecast as you see here for PPI into 2024, a continuation of the deceleration of those prices, and this tight relationship with the core PCE deflator, personal consumption expenditures. This is taking out rent, but you can see there's a pretty strong relationship here, and this is again kind of a very visual representation of what I strongly believe will be an impulse to drive consumer inflation lower. Now we'll talk about the market a little bit. Bond market volatility has been actually well in excess of stock market volatility as late. You can see the MOVE index here on the left-hand side. Right-hand side, spreads have widened. So this is when you see spreads widening, that typically is the market pricing in a little bit more uncertainty as far as the economy goes, a little bit more uncertainty with regard to the credit worthiness and credit quality of some of the instruments that are below the risk-free rate, certainly, and the ones that are approaching investment grade status or that threshold. And so you see investment grade spreads. These are bonds that, you know, for all intents and purposes are expected to be roughly money good, but these spreads go up when you have increased deceleration priced into the market, and that's clearly what's going on here. Here's a VIX chart for equities. We just saw bond volatility pretty high. Stock market volatility is very low, very unusual for this time. Thought we'd see more volatility right now, but you can see that number is near lows that over the last 18 months. This is an interesting chart from S&P Global here, and this is a survey for institutional investors, and there's summary points below. Risk appetite for the next 30 days, and this is a fairly recent number too, and so and then expected equity market performance in the next 30 days. And I just got through telling you that equity market volatility is pretty low, but the expectations looking ahead 1 month to 2 months is actually not that great. So we see here in these summary points, not to be redundant, but risk appetites is at a low point, roughly a year low. And then we've got concerns kind of building over recession risks. Again, the most anticipated recession that I think we'll ever have in modern history here, but that concern is being priced into, at least at the institutional level. Here, and then you've got more of a defensive shift, and with financials being sold off in favor of healthcare, and then we're clearly seeing an expectation that cash is going to be a good performer this year, and I happen to agree in a lot of respects. Here is the S&P 500 forward PE ratio, price to earnings ratio. We're about 19 times. So amidst this low volatility, although we've got this institutional investor sentiment, which is a little mixed as we saw on the last chart, but multiples are actually moving higher. So about 19 times. I'd say that we're at a point now where we're probably overdue for a little bit of a sell-off here to get that number back down to about 16, 17, which is, as you see here, our median number is 17, and if you look at like 13 and then 21, those are a standard deviation away from that median. And what that means is that about 67% of your occurrences for PE, for your observations for the price to earnings ratio, are going to be between the 21 and the 13, and about 33% of those observations are going to be outside of that. And you can see that the market is neither cheap nor expensive, but it's a little bit more expensive than it is cheap right now. Here's a quick look at oil prices, a pretty busy chart. This is kind of a candlestick chart. So you see intraday and closing, and it's a little bit busy. These two red solid lines are there to indicate that we were in kind of a consolidation pattern for all the technical analysts out there, dating back to December. So, we were straddling 80, 70 to $80 a barrel, and then we dipped below, and you could see where that had an impact here in beginning of March as we, kind of like fell through the floor there. But then we suddenly kind of spiked higher over that consolidation line, and that had a lot to do with the announcement of production cuts on the part of OPEC plus, and obviously is manifesting itself in real time through some of these consumer inflation numbers related to gasoline. Here's a quick look at the International Energy Association, IEA, global oil supply and demand estimates. And interesting thing here is, despite the risk of a slowing economy, we do have fairly strong demand overall, with an undersupply is what they're looking for over the next several quarters. And that's meaningful because that will help to sustain higher energy costs heading through, throughout the remainder of the year, I should say. Now we look at gold prices, which have really had a tremendous run. If you look at, this chart, which goes back to about 2009, we troughed out around 2016, and then we've been, in a general uptick ever since that point. And gold prices have really shot higher lately. You can see here that we're not too far off our all-time high, which was during the kind of the pandemic, if you will. And I think gold has a lot of staying power. We've got a chart following this, which would certainly tend to support that theory, but gold has been really strong here lately. The chart that I was telling you about on the last slide is one that kind of pairs gold to S&P, and it creates a ratio. And it says, all right, well, after you had 70% of the yield curve inverted, we know that we have a very inverted yield curve right now. But when we reached a point where almost a little bit more than 2/3 of it was inverted, this ratio and Crescat Capital, I don't really know these folks, but it's interesting research. But once you hit that point, what they do is they track the gold Standard & Poor's ratio. And what this tells you is that at that point, and they kind of peg where we are right now in that green line, that we're about 5-6 months after 70% of the yield curve inverted. That if history is any guide here, that if we look over the next year and a half, if you will, that it's building a pretty strong case for gold relative to stocks. Not saying that stocks are going to be weak, but just saying that the relative performance of gold is going to be fairly strong. Here we have the dollar index that we'll end on right now. As we saw 2021 and 2022, we had an exceptionally strong dollar. Bad for exports, bad generally speaking for energy and other commodities. They're generally priced in dollars. But the interesting thing is when we got into the fourth quarter of last year, that really has reversed quite a bit. Now we did have a little bit of an uptick here in the first quarter, but we've retraced that gain and we're now back to where we were at the beginning of February, essentially, and we're basically back to about May levels of a year ago. So the implications for weaker dollar actually good for exports. I think it remains to be seen whether what the trend in the dollar is going to be. We thought that the dollar would probably weaken up because it was far too strong about 6 months ago. So, and that has happened, but it might be a little flattish from here because we have, a mixed bag of short-term interest rate increases. We've got, New Zealand and some areas that are increasing rates. We're expecting a 25 basis point increase If the next Fed meeting, so higher overall rates, but not a big shift from one region to the next. Europe is doing a bit stronger, so euro relative to the dollar has strengthened a bit. I'd say the dollar is going to be pretty resilient, but with probably fairly unremarkable moves from here over the near term. That's all we've got for this week. Hope you've enjoyed the chart pack. Have a great week, and we'll talk to you again soon. Take care.